You don't need a six-figure bankroll to chase big returns. Some of the most powerful opportunities sit quietly below the $100 mark, hidden, undervalued, and overlooked. These aren't the mega caps everyone knows. They're the under $100 stocks that could redefine your portfolio by 2026. What they lack in price, they make up for in potential, because sometimes the biggest gains come from the smallest footprints. Most investors underestimate these lower-priced stocks, assuming cheap means weak. But in reality, price doesn't define value. Fundamentals do. These are companies quietly building, innovating, and positioning for the next economic cycle. They don't dominate headlines today, but when momentum shifts, they're the ones that explode upward while others are still noticing. The real wealth in markets often belongs to those who see early and act with patience. There's a fine line between speculation and strategy, and the key difference is research. The right under $100 stock isn't a gamble, it's an opportunity waiting to be recognized. As market cycles evolve, smaller and mid-tier companies tend to rebound faster than blue-chip giants. That's where the real asymmetric reward lies, where downside is limited by value and upside is fueled by vision. So today, we'll spotlight 3 powerful stocks under $100, each representing a unique path to potential, one stable, one growing, one disruptive. Together, they form a strategy for investors who think long-term, stay disciplined, and recognize that opportunity doesn't always come with a big price tag. Let's dive in. 1. The undervalued giant, Pfizer Inc. PFE. Pfizer trades for around $25, yet carries the strength of a global pharmaceutical powerhouse with over a century of experience. Behind its modest stock price lies a company with a robust balance sheet, consistent cash flows, and a deep innovation pipeline. Its fundamentals remain solid, but short-term investor fatigue has pushed its valuation far below its intrinsic worth. The market has punished Pfizer for the post-pandemic slowdown, but it's forgetting something crucial. This company isn't a one-hit wonder. It's a global healthcare leader with over 100 active research programs, a steady dividend, and a proven ability to pivot. Its focus on oncology, vaccines, mRNA technology, and rare disease drugs positions it at the heart of future medical revolutions. Pfizer is also making bold moves, restructuring costs, acquiring innovative biotech firms, and targeting long-term revenue growth through breakthrough therapies. Analysts suggest that even modest success in late-stage trials could dramatically shift its earnings trajectory. Pair that with a 5% dividend yield and buybacks on the horizon, and you get a mix of stability, income, and recovery potential. It's not flashy, it's not speculative, it's strategic. Buying Pfizer under $30 isn't chasing hype, it's capturing resilience. When the cycle turns, those holding patience and conviction could be the ones smiling when others rush back in too late. 2. The growth engine. Under $100. Marvel Technology. MRVL. Marvel trades comfortably under $100, yet it stands at the crossroads of some of the fastest-growing industries in the world: AI, data centers, and semiconductor. The company's technology powers everything from cloud infrastructure to 5G connectivity to autonomous vehicle. In short, it builds the backbone of our digital future. Unlike many of its peers, Marvel isn't relying on one product or market segment. Its diversified revenue streams provide resilience, and its innovations in data infrastructure give it a long runway for growth. As demand for AI processing power and cloud capacity skyrockets, Marvel has positioned itself as an essential enabler, the picks and shovels of the digital gold rush. The company's most recent earnings reports show robust revenue growth and expanding profit margin, thanks to its leadership in next-gen semiconductor. Its focus on custom chip solutions for hyperscalers like Amazon and Microsoft gives it exposure to explosive AI-driven spending trends. What makes Marvel compelling is its balance between innovation and stability. It's profitable, forward-thinking, and deeply embedded in a multi-decade technology transformation. If it continues to execute and capture AI infrastructure growth, this under $100 stock could easily become a standout performer by 2026, potentially doubling or more as its story unfolds. For investors who missed NVIDIA's early days, Marvel represents a second chance, not a clone, but a cousin of that same exponential energy. 3. The disruptor. Archer Aviation, ACHR. Archer Aviation, trading near $80 per share, sits in the category of high volatility growth trades, the kind that attract traders looking for early momentum before institutional money steps in. Over the past year, ACHR has shown a pattern of sharp speculative rallies followed by deep pullbacks. typical of a pre-revenue company in a developing sector. That volatility makes it risky for long-term stability, but potentially rewarding for short to mid-term traders who understand timing and sentiment cycles. The stock often moves on news-driven catalysts, partnerships, regulatory updates, or prototype milestones. Volume spikes during announcements, suggesting strong retail interest but limited institutional commitment so far. From a trading perspective, that means opportunities for swing setups, buying during consolidation zones and trimming profits into strength when hype returns. Technically, ACHR's support has held between $5.50 and $6, while resistance remains around the $9.50–$10 zone. Levels traders should watch closely. A confirmed breakout above $10 with volume could open room toward $12–$13 in the short term, but a breakdown below $5.50 would likely attract aggressive short interest. In essence, Archer isn't yet a fundamentals play. It's a sentiment-driven trade. For investors, it's about position sizing and risk control. For traders, it's about recognizing volatility as opportunity, not danger. If you're building a balanced trading portfolio, Archer can be your speculative momentum leg, small exposure, tight stops, and high potential upside. It's not the stock you hold for dividends or predictability, it's the one you trade with precision, discipline, and awareness of market psychology. 4. How to build your hidden gem. Portfolio building wealth isn't about finding one miracle stock, it's about creating balance. The most effective portfolios blend stability, growth, and innovation. Pfizer provides the anchor, income and defense. Marvel delivers expansion, technology, and scalability. Archer brings vision, future potential, and bold innovation. A smart structure could look like this: 50% Pfizer, 30% Marvel, 20% Archer. Adjust depending on your personal risk comfort. Reinvest Pfizer's dividends, use Marvel's growth to compound, and let Archer's potential remain your asymmetric bet. Monitor catalysts closely: Pfizer's drug approvals, Marvel's data center contracts, Archer's FAA certifications. Each event can unlock a new wave of valuation. Above all, stay patient and consistent. These are not day trades, they're long-term stories unfolding one milestone at a time. Hidden gems shine brightest for those who hold through the noise. The market rewards conviction and punishes panic. Know which side you stand on. 5. Watch the risks and stay disciplined. Every stock, even the great ones, carries risk. Pfizer could face regulatory delays or weaker pipelines. Marvel could struggle with global chip cycles or margin pressure. Archer could face certification or funding setbacks. The key isn't to avoid risk, it's to manage it. Set clear entry and exit points. Diversify beyond sectors. Keep your expectations realistic and your emotions in check. Smaller stocks tend to move faster, both up and down. Don't let volatility push you out of long-term opportunities. The smartest investors treat the market like a business, not a casino. Research deeply, build conviction, and always protect your downside. In the long run, discipline will beat hype every time. So here they are: 3 stocks under $100 that could define the next wave of opportunity by 2026. Pfizer offers foundation and income. Marvel provides growth and innovation. Archer brings imagination and possibility. Together, they're not just investments. They're a vision of what balance and foresight look like. The real question isn't which one will win. It's whether you'll recognize value before the crowd does. Because in investing, fortune favors the early, the patient, and the prepared. If this video helped open your eyes to what's possible under $100, hit like, subscribe, and share it with someone who's still chasing overpriced hype. Sometimes the next great story is already here, just waiting for you to notice. Start now, invest wisely, and let time do its quiet compounding magic. Because the biggest opportunities don't scream, they whisper. And those who listen early win big.